Hey, welcome back. Today I want to talk to you about a company that I think has a significant amount of upside. It's VF Corporation. You may be thinking, what in the world is VF Corporation? Well, this graphic here gives you an overview of what VF Corporation looks like. Some of their most famous brands you can see are Vans Off the Wall, the North Face, Timberland, and then they have some others such as Dickies, which manufactures clothing for work environments. There's some other lesser known brands on here that you can see as well. And you can see some of the things that VF Corporation has been doing over the years as they've divested themselves of some of their previous brands, including Wrangler and Lee and Riders. Why do I think this company has significant upside? Well, you can see here from this graphic that their core addressable market is approximately $500 billion. And you can see from the two larger circles there where they're concentrating their efforts. Active and athleisure, I love that combination of words that companies throw in sometimes, as well as outdoor and outerwear. During a pandemic, how do you think some of these things will fare? I think a lot more people now are trying to get outdoors, away from big crowds. And when you think about things like health and wellness and experiences, VF Company is right there trying to make people's experiences much more pleasurable, either by having comfortable footwear or keeping them warm or providing the tools that they need to experience their outdoor activities. Well, let's just look at what VF Corporation was doing before the pandemic. You can see in September of 2019, year over year, they had a 5.4% increase, and for that quarter, they did $3.39 billion in revenue. If we look at December of 2019, we can see they were holding steady again at $3.38 billion, and again their year over year was up almost 5%. We fast forward to March of 2020 when a pandemic started, and we see that their revenue was cut way down to $1.4 billion with a almost 15% year over year drop. Then we get to June of 2020 and we see that their revenue decreased yet again to a little more than $1 billion with an almost 50% year over year decrease. Normally we might think that this is a company in trouble, but I think if we stop for a moment, we'll see that this is a company that was doing very well until a pandemic hit and probably disrupted some of their supply chains, as well as caused decreased sales, like many other companies, as many of their stores were closing. One of the nice things I see on this chart, though, is if you look at cash on hand, they have $2.15 billion cash on hand still. So although their revenue has decreased significantly, they still have plenty of cash to operate their business. Here's how the company expected to grow during their 2019 investor presentation. This was a 5-year plan, so extending out to fiscal year 24. You can see that their big four brands, Vans Off the Wall, the North Face, Timberland, and Dickies, expected to have a growth rate of 8 to 9%. You can see that they were still doing about that same, or planning to do the same, for their international growth. What I like here is you can see that direct-to-consumer growth was planning to still hold relatively steady. They were doing 16% during the 3 years before that, but at 13 to 14%. I think we might find that their direct-to-consumer growth will be increasing even more now with the pandemic. If you aren't familiar with those 4 core brands, let's just quickly take a look at them. So Vans, you can see here from this graphic how nicely this brand has been growing from revenue of $360 million in 2004 to roughly $3.7 billion for 2019. This is how the Vans line fits into that $500 billion addressable core market. You can see they concentrate on the active and athleisure with the experiences and streetwear, as well as a little bit of outdoor wear and packs. Another of their core 4 brands is North Face. Who hasn't heard of North Face? North Face considers themselves the world's leading premium exploration brand, and I think they're right. Here's how North Face fits into that core addressable market. You can see they're concentrating on the outdoor and outerwear with a little bit of the active and athleisure as well as packs. And they combine that with streetwear and performance wear as well as experiences in health and wellness. They're not just for mountaineers, but also for people who might like to enjoy the outdoors on a hike, or people who might like to enjoy the local city life doing some urban exploration. Timberline is another of those core four brands. They started out, of course, with their yellow boot, but you can see here that they've diversified nicely. And here's how Timberland fits into that 500 billion addressable market. A little bit of each of the active and athleisure as well as outdoor and outerwear. Again, packs. I saw something that said that VF Corporation has 55% of the backpack market in America. That's an interesting statistic when you think about all the children who purchase backpacks every year as well as hikers. Obviously, that market may have gone down a little bit this year as fewer children are attending school in person, but I think that'll be coming back. And finally, Dickies. Dickies has been around since 1922. They started providing workwear for American workers with high-quality overalls and pants. And over the years, they expanded that out to include casual wear, and then the 1980s with dyed painter's pants. They became a bit of a pop icon there in the 90s. And then in 2017, they were acquired by VF Corporation after being in business for 95 years. And here's how Dickies fits into that addressable market of 500 billion. You can see here in green that their concentration is in workwear with a little bit of outdoor, a little bit of packs. They're looking at experiences, new business models, and streetwear. Now, why else do I think this company has some upside? Well, let's just take a look at some of their stock price. You can see that the overall trend over 5 years has been nicely upward. In fact, just before the pandemic, they were trading right around $100 per share. And then, of course, they took that drastic, steep decline in their share price, all the way down to a low of $45.07. Now, you can see that nice climb coming back. They still haven't made it back to their pre-pandemic stock price yet. Obviously, they're not doing the same amount of business, so I think their share price is reasonable. And if you look at the analyst estimates, you're going to see that they agree. They're hovering right around $72 to $74 or so a share on analyst estimates as an average. But I think this company is well positioned to return to its pre-pandemic stock price. Why do I think that? Well, we just went over its four core brands. You can see that those are brands that people know and trust and use. And again, during a pandemic, many of those are going to get used even more, I think, as people try to experience the outdoors. As I stated before, I think that they're a solid company, as we saw from their previous financial performance. And also, as I stated before, they have plenty of cash on hand. They've helped with that cash on hand by deferring on their stock buybacks that they had planned for the year in order to conserve cash. Now, why else do I like this company? They pay a dividend. Right now, that dividend yield is 2.53%, which you might be thinking is not all that great. But if you've checked the savings account rates recently, you'll see that 2.5% is really fantastic. Now, again, that's just a dividend. That's just money they pay you for owning their stock. So not only do you have the potential for this stock price to return to its pre-pandemic price, but you can be locked in at that 2.53%. Even if the stock price goes up, your purchase price now would continue to be paying you 2.5% of that original investment. I think that dividend yield is something that gets lost in the woodwork sometimes because, of course, as their stock price goes up, the dividend yield starts to go down, and we think that we're getting less of a dividend. But we have to remember that that dividend is paid on our original purchase price. In fact, I read something recently talking about Warren Buffett and his purchase of Coca-Cola stock, that his average purchase price is right around $3 and some change. And of course, Coca-Cola is paying like $1.50 per share now. So Warren Buffett's doubling his investment every 2 years just on his dividend return. So keep that in mind. 2.5%, unless VF Corporation changes their dividend, which any company has the prerogative to do. I have invested some of my money in VF Corporation. I plan to invest some more of my money in VF Corporation. Their earnings report is coming out on October 16th. I'm excited to see what they have to say. Even if their earnings haven't returned to pre-pandemic levels, and I don't anticipate that they will have yet, even if they haven't returned, I'm still excited about VF Corporation.